Welcome to the Alpha Wolf Impact Club. I'm Tim Weintraut, and this is where we shine a light on small companies with big ideas. Our mission here is crystal clear. We want to identify, support, and champion game changers. Those companies that are tackling massive challenges, revolutionizing industries, saving lives, or making us more efficient. For example, today we have Glenn Messina, CEO of Onity. Onity is a mortgage company, but this is a company that is very focused on the customer and all stakeholders. They want to ensure that everyone has an excellent experience. What I love about this company is the way they are using AI. They're not using it to replace humans. They're using AI to help enhance service for all parties. I think this is a brilliant example of how you embrace technology, and I'm going to let Glenn tell you more about that in just a moment. Folks, this is not meant to be investment advice. I am not a financial advisor. It is for education and entertainment purposes only. I recommend that you do your own due diligence. Hey everybody, Tim from Alpha Wolf Capital coming at you with a brand new company that I'm pretty excited about because it's just a fantastic story, really. We have Glenn Messina, CEO of the Onity Group. Glenn, we met about what? Was it 2, 3 weeks ago?
Yeah, it was, maybe almost a month ago now with the holidays in between. Yeah.
Yeah. And I thought we had just a fantastic conversation. And I was really excited about doing this interview. And I'll tell you straight out that typically I'm playing around with stocks that are in pennies and just over $1 or so. But
Okay.
this stock is look, I still think it's cheap where it is today, and I think there's good opportunity here. What I'd like to do is have you give us a little background on you
Hmm.
and how you got here, right? A little bit of your history maybe, and then talk about the company, the vision that you have for the company, and the strategy that you intend to use to achieve your goals. Does that work for you?
Sounds great, Tim. And yeah, hi everyone. And Tim, thanks for the opportunity to chat with your follower base here. Really appreciate it. So yeah, Tim, my background is just generally speaking, spent about a third of my career in commercial finance, third of career in consumer finance, another third in commercial industrial services. Worked with, spent 9 years with the Verizon predecessor company called Bell Atlantic, 17 years with General Electric, and then worked with a small cap mortgage and fleet leasing business, PHH, and then now 7 years with Onity. Um, Early on in my career, I started through the finance track, developed a knack for identifying problems. Early in the career, I was bounced around between a couple of businesses with the, hey, kid, go over here and see what's wrong there and see if you can fix it. And, that, quickly got me the label of being, a transformation leader or a turnaround person. So, I ended up going through a series of businesses where they were struggling for some reason, and it was up to me to figure out what was needed to right the ship, implement the plan to right the ship, and then take the business forward. And when you're doing that, it's certainly you always learn a ton. Every situation is a little bit different. The approach is generally tried and true in terms of what you do from a diagnostic perspective. But look, when you're trying to take a company that is lagging competitors, it's got some challenges with the returns, financials, people, whatever, you have to kind of, you're gonna got to go on the leading edge, right? You have to take some risks. You have to focus on innovation. You have to be an early adopter of things and trends you see in the industry, and move the business forward. And I did that successively through my experience at Verizon, joined General Electric, and worked in GE Capital and the GE Industrial side. And got tired of the big company stuff, went into the small cap world. It's been a blast. I've had a ton of fun with it. But, when I joined Onity 7 years ago, it was probably one of the most challenging situations I had ever faced in my career. The company was facing quite a few challenges. Literally every aspect of the company needed to be transformed. The company had, was losing money. It was the cost structure was bloated. There was, over 30 state administrative actions. There was litigation with the CFPB. Relationships with Fannie Mae, Freddie Mac, and Ginnie Mae were strained. The core business was servicing mortgage loans, residential mortgage loans that were originated before the financial crisis, so subprime loans, not agency loans. And look, that business was shrinking. The portfolio was running off. There was one customer that was about 60% of the
Ooh.
servicing portfolio. And yeah, that was nerve-wracking to say the least. And look, the technology platform needed to be replaced. And as I think about that one dimension about replacing the technology platform, that was one of the massive opportunities in transforming a business was the technology platform, and we'll get there. But look, we crafted a comprehensive transformation plan. It had to cover strategy, culture, talent, technology, the business operating system, and obviously regulatory and investor relationships and financial performance. And look, we reset the strategy and the culture. Over today, if you look at the business, over 50% of the leadership team is new from when I joined, new to the company. Another 20% are new in position. Half the board of directors are new. In the last 7 years, we've resolved the significant regulatory matters for the company. We've normalized relations. We've built a new technology platform stack that's cloud-based. We also built an automation center of excellence to drive artificial intelligence, and we'll go down that path in terms of some of the cool things I think we've done and where we're going. Obviously, right-size the cost structure, and built a multi-channel origination capability to grow, replenish, and grow our servicing portfolio. So, look, we rebranded the company in July of 2024. At the end of 2024, we did a big balance sheet restructuring. We simplified and reduced our corporate debt structure to strengthen our balance sheet and extend maturities. Which obviously gave the company more runway to drive growth and profitability. Transformation continued in 2025. In the first quarter, we established a full-time shareholder relations function. So, that's how we got to you, right? We were largely internally focused prior to 2025 with a lot of work to do to get the company to where it is today. But yeah, we're now really beginning to tell our story. And we are so far removed from the company we were before. Today we are originations growth is outpacing the total industry for 2025. For 4 consecutive years running, we've been recognized by Fannie Mae, Freddie Mac, and Ginnie Mae as a top performing servicer. We receive a 55 net promoter score from our subservicing clients, which is kind of equivalent to where Apple and Google and some major players in the industry are rated. NPS being a very punitive and unforgiving customer satisfaction measure. Our consumer direct originations channel has a 70 net promoter score, and we get 4 out of 5-star ratings by consumers for positive call center experience and positive loan boarding experience. Probably even more, I tend to overlook it, but today we rank as one of the top 10 independent mortgage banks in total servicing, subservicing, and correspondent lending. And so what does that mean? Well, there's roughly 900 independent mortgage banks in the United States, and we're in the top 10. And that's from a company that was shrinking into irrelevance when I joined the company. So couldn't be more proud of the team for what they've accomplished. And again, a huge part of that has been the right culture, the right strategy, and very thoughtful and prudent investments in technology to create a platform that's super competitive, without necessarily relying upon raw scale, which a lot of our other competitors do.
Well, I'm reflecting back, and if I get something wrong, just go ahead and nail me on it. I think from our previous conversation, you had indicated that you had somewhere around 190 uh, AI applications. Is that right?
Yeah. So when you think of what we've done from an AI perspective, right? So we focus on four dimensions of AI. So, first is robotic process automation. That's where that 190 number comes. It's now over 200 processes that have been automated through robotic process automation, which is saving tens of thousands of hours in it's actually 85,000 manual work hours per month across those 200 processes. So the next is natural language processing. So think voice bots, chat bots, right? So roughly 88% of our customer requests are handled digitally today. 30,000 requests. That's about 30,000 requests answered by chatbots, which is really pretty cool. We also use optical character recognition and intelligent data extraction from mortgage documents. So mortgage loans, if everybody's gotten a mortgage, it's just like a massive mountain of paper. And unfortunately, that's just the way the 50 states like it and the way Fannie Mae, Freddie Mac, and Ginnie Mae like it. But what that could create an operational burden for us. And to give you a sense, we use our vision processing or intelligent document processing to process 25 million documents a month in our shops. It's just staggering proportions of work that, frankly, these were, frankly, we always had a challenge with retaining people to actually do these jobs, right? So it's jobs that people actually didn't want. Turnovers were extremely high. We're talking 16, 18% a year turnover in these jobs. And we've used technology to say, okay, look, if you want to run a successful company, you can't be retraining 18% of your workforce all the time, right? So you've got to use technology to take the work that people don't want to do fundamentally and do it in a more constructive way so you can free people up to do more value added things and then use technology to empower and enable them.
I love that. See, I love that whole philosophy that you have. And I asked you before we hopped on if you've been an early adopter by nature. And because of the position, your background, and where you were at,
Mhm.
and how they utilized you, it kind of almost forced you to become a early adopter, right?
Yeah, I can think back, across a variety of different experiences. So things like Lean Six Sigma. I was in a business that, was in General Electric, and Jack Welch was a Six Sigma zealot. And we had a business where the operations were truly strained and, delivering not really delivering a great customer experience, a lot of rework and stuff like that. And it was just ripe for an application of Six Sigma. And we created frankly, this is back in the mid 1990s, a data-driven dashboard approach to managing operations in a service level business, which was unheard of at the time. And it just revolutionized how we thought about the business and, how we drove performance in ways that mattered, not only to our shareholders, in this case, the General Electric shareholders, but, mattered to our customers as well, too. So, in the chemicals business, using frankly, genetic engineering for detecting Legionella bacteria. Stuff that scientists created in the lab were just amazing. And when I got to Onity and I saw okay, so we got to, there's actually a regulatory order that the company had to change its servicing system. It's just like, well, okay, if you're going to change the servicing system, why don't you just not start from scratch? Do servicing, originations, capital market system, general ledger, HR, put it all in the cloud and have a foundation you could build off of, right? And we built this automation center of excellence. It was on a shoestring. It was like, three people, working in a conference room type of thing. And they started to just generate ideas of, okay, well, what if we develop these bots? And then, what if we did, we got into natural language processing and so on and so forth. And, today it's evolved to really the focus of integration of all of it, the robotics, the large language models, and machine learning across all of our operations to really empower people and processes. And an example of that would be, um, so you're a customer and you call into our call center, and through the call identification process, you're going to talk to our voice response unit or enter into a chat or whatever that you may have a concern over escrow or property taxes, or you may want to refinance your loan. Well, we can take that data now and route your call to the customer service rep who has the most experience in solving and resolving those type of issues, right? So it's about matching the customer need with the individual who's best skilled at solving that. Another example would be with our customer service agents on the phone. We have an AI agent who's transcribing the call in real time as the customer speaking, and it's we're identifying what the borrower call sentiment is. So if they don't understand or they're getting frustrated, the customer service agent can get prompted to either slow down or speed up, or the customer's getting frustrated, or and to begin serving up to the customer service agent based on what the customer is saying. Here are suggested ways in which to solve the customer problem. So you're delivering to the customer service agent real-time information to help them be more effective at their job and to deliver a better consumer experience. And Tim, our philosophy in the company is pretty simple, right? So we obsess over our people, we obsess over our customers, and we obsess over hitting our targets. And you can use technology to kind of put that all together, right? So you can create a more effective person. And look, business is still about relationships and people to people, and building a bond of trust with your customers so that you can create a customer for life. And in order to do that, you want to make sure your people have the best data available to them. You're giving them the information they need real time to deliver a great experience for the customer. And whether that be a salesperson or a customer service agent, it could be a home retention specialist if somebody needs a loan modification. All across the business, we're thinking about how do you deploy technology to empower our people and processes where every process is optimized, every decision's data informed, so you could deliver a superior outcome every time.
Right. I see. This is exactly what I see. I mean, I know a lot of people are afraid of change. They're afraid of AI. Everybody's going to lose their jobs. I don't see it that way. I see you are the perfect example of how technology can be used to enhance and
Yeah.
make people's jobs more enjoyable, really, right? Because
Yeah.
I mean, if I've got something helping me to detect whether the guy on the other end of the phone or gal on the other end of the phone is getting irritated, and that, it gives me a suggestion of how I can maybe diffuse that, I think that's fantastic, right? I mean, it's
Yeah.
still a person talking to a person, but you've got something that's helping you identify something that you might not have recognized just that on your own, right?
Exactly. Exactly. And look, there are some, there's a look, we're all humans, we're all different. We all, there's things that excite us and things that delight us and things that frustrate us. So look, there's a cadre of our customers who, they only want to deal with the chatbot. They want it all through the mobile app. They want it all through the web. And great, we'll do that too. But it's a surprising portion of customers who, at some point in time in the process, they're like, well, wait a minute. I'm really unsure of what to do here, so I think I need to talk to somebody. And you want to put them in contact with someone who's going to really be informative, instructive, and helpful, and to guide them along the process to produce the best outcome for the customer. So to me, it's a tool to create a better outcome. And Tim, I'll tell you, I went to Ramapo College of New Jersey. I went to night school as a tractor trailer driver and heavy equipment operator in a scrap iron yard, and that's how I worked my way through college. And I, owe a lot to this small, public school in northern New Jersey. But every semester I go and I talk to the management class, the graduating seniors in their management class. And AI was a big topic of conversation with this student body. And I tell you, very high level of anxiety, very high level of concern. Is AI going to take my job? Is, am I going to have an entry level job anymore? And there was this angst. And number one, I assured them that, look, we've seen, the IBM PC, the AS400, the, server-based technology. We've seen .com and all. Look, technology innovation has been around forever, right? Our job as human beings is to evolve and adapt. And, when you think about it, all even, Microsoft Copilot, AI agents who, write whatever emails or memos or whatever, if you're going to respond to a customer over an issue, you have to know how to prompt the AI agent. You have to know how to prompt it in a way with both facts and a sentiment so you get the right stuff out of it, right? So the need for the human to engage and guide the technology is still there. So, look, I think at the end of it, people kind of, their blood pressure went down a little bit. Everybody breathed a sigh of relief that, look, it's not, it's not a substitute for um, people in the workforce. It's a tool to enhance your performance. And if you approach it as a tool to enhance performance, I personally think the opportunities are limitless, right? So both, for us individually as human beings and for and for our company, for Onity.
Yeah, I mean that's how I see it. We can either wind up in utopia, or right where everybody is living a pretty good life because we're very efficient, we're safer, we're faster, right?
Yeah.
Smarter. I don't see how those things are a bad thing. I see how those things could be really, really good for everybody, right? And as I look at companies, this is the advantage that retail investors have. If they can identify a good company that is ahead of the curve, that is going where the puck is going and not where the puck is. That's an old hockey analogy,
Yeah. Yeah. I know it well.
right?
Yeah.
If you go to that, if you go where it's going to be, typically that winds up ending up in a good result, right? And
Yeah.
if you, as an investor, if you can identify that early, here's your advantage. The big boys, the big funds that have, $10 billion under management and they deploy their capital by a percentage of their portfolio. If it's a small cap company, a lot of times they can't even look at it because they're too small. They need the
Mhm.
retail investor to help that company get to a certain market cap. And then once that market cap gets obtained, then the big boys can start playing with the stock, right?
Mhm.
And I don't think people recognize that if you're good at identifying good companies with good management teams that are early adopters, and my whole thing is as I look at companies and what happens to them on Wall Street, a lot of the small cap companies they start out, they they build it, and they think because they built it, their customers will come. That's field of dreams. That's not reality, right?
Mhm.
You now the hard part starts. You got to go out and you got to get everybody to adopt whatever it was you built. And I don't care what it is. It could save lives. It can make things more efficient. Getting people to change is very difficult,
Mm.
right? I mean, there's like 3% of the population that are early adopters. And that's not enough. You got to get to 80% of the population to become the
Yep.
standard, right? And that's a very difficult curve. The adoption curve is what is so challenging. That's what kills companies on Wall Street because what happens is they think they're going to get to cash flow positive and profitability way before they actually can get to cash flow positive and profitability.
Mhm.
So then they become basically uh, chum for the financial institutions. I mean,
Yep.
it's unfortunate, but this is the reality of life. And
Mhm.
the people that start these companies, it's not, they do what they do extremely well. What they don't understand is the capital markets, and that sometimes these institutions are not necessarily your partners and your friends. They are looking for the quick hit, the you know, and that's where you get the terrible terms on financing, and that is the
Mhm.
beginning of the death spiral, right?
Mhm.
And they don't understand that. Where the masses can help is when they recognize these companies and they adopt them early, because they're consumers too, right? So I mean, as a
Mhm.
consumer, you can help a company, word of mouth, telling other people about that company, right? How did
Yep.
Starbucks become so popular? How did Apple become so popular? The consumer has a lot of power. I mean, they really do. If they just looked at it like, oh, wait a minute, instead of just buying their product, maybe you should buy their stock too,
Mhm.
right? And that's how you fill the gap between the haves and the have-nots. The retail investor has the advantage because they can adopt early, and they can help that company achieve success because they shrink the adoption curve, which means they don't have to rely on the financial institutions to survive, right? At some point, they get to profitability or cash flow break even, and that the whole world does better because of that, right?
Yep.
Does that make sense to you, Glenn?
It does. And, as I think about the journey we've been on, change and change management has been such a huge part of it, right? So how do you get your people kind of get their heads wrapped around? Look, for us, it was about reinventing pretty much everything in the business. Um, and technology was a core part of that, but the culture and the strategy and everything was a core part about it. So, getting people to engage with that and getting people to see what is the company we're building for the future, and how what do we want to deliver? And for us, it was about building a company that delivered unparalleled performance and value for our customers. We were just anchored in that vision. It's all about delivering unparalleled performance and value. Because if you can't deliver value for your customers, then you really don't have a business model. And whether that customer is the consumer, whether that customer is one of our commercial customers as a subservicing client, whether it's a mortgage loan investor like a Fannie Mae, a Freddie Mac, a Ginnie Mae, or frankly shareholders, right? We have a product which is a stock, right? And your customer is the shareholder, and making sure you have a company that can deliver adequate returns for your shareholders. So, we put a very straightforward strategy around balance and diversification, prudent capital light growth, an industry leading cost structure, top tier operating performance, and dynamic asset management. And frankly, everything about our business was driven to support those strategies, driven to support that vision. And it just you got to have the stomach to do it over time. And look, Tim, we're not. I think in 3 to 5 years, if you're going to be in the financial services game, you need to be a fintech. And I think how we think about fintechs today. Well, 3 to 5 years from now, everybody's going to be a fintech. If you survive, you're going to be a fintech because you're going to have to be, right? Because consumers, your customers, whether it be a commercial client, a consumer, or even shareholders, are expecting it. But look, we don't run our business with the mindset of the way some technology companies do it, where you just plow a ton of capital, a ton of money, and don't deliver any return on investment until some future point down the road. We've all been, as we've thought about our journey as a company, it's look, we want to get the company to profitability. We've had probably 3 years of steady improvement in adjusted pre-tax income, and it delivered robust improvements in GAAP net income over the couple of years we've been here. Um, but it's all about thoughtful, prudent investments that actually have a business case around them, right? So we don't just experiment with technology. The technology has to have a business purpose. So will it drive revenue growth? Will it deliver an operating advantage? Will it help us deliver a superior customer experience? Will it enable customer retention, right? So it has to fit one of those four baskets. And if it doesn't fit one of those four baskets, we're not about wasting a lot of time and money, whether it be human capital, energy, mind share, labor hours, in pursuing things that can't really accomplish an outcome that's going to matter to a mortgage loan investor, to a customer, to a client, to a shareholder. And I think that is probably, I don't know that that's rocket science. It doesn't, to me, it doesn't seem like rocket science, but look, if you're a small cap, you're working on a shoestring, so you got to be very prudent and thoughtful about what you do. And this isn't a story about spending money on technology for technology's sake. There's a very focused business purpose about how we invest in the company. And so many people in our industry become a slave to scale because it can be a very high cost structure industry with a lot of fixed cost and a lot of human capital associated with it. So people will, do a lot of M&A and, get for bigger and bigger scale to try to create an economic model that works, a servicing cost structure that works. And for us, we look at our performing loan servicing costs as reported by this is the Mortgage Bankers Association 2025 Servicing Operations Study. Our performing cost per loan, as they define it, is 23% cheaper than the large servicer average that they report. And our cost per loan for servicing non-performing loans is about 52% lower
Wow.
than the the large servicer average. And that's a combination of banks and non-banks. And some of these people are, 3, 4, 5 times our size who participated in this study. And I tell you, I was just steadfast and adamant about, look, we can't, cost is a competitive advantage in this industry. It just is. We can't operate without having an effective cost structure. You can't compete without having an effective cost structure. But we can't be a slave to scale to get it because scale has its own drawbacks. And, going through a big refinancing wave and stuff like that is, you have to add on mountains and mountains of people to deal with, the loans that want to refinance and loans that are paying off. So you have to focus on developing a competitive advantage in your cost structure by doing it faster, better, cheaper than your competition, right? So technology coupled with continuous process improvement and continuous cost reengineering has been the way we've driven our cost structure. And, if you just look at it from a big picture perspective, the business today is, probably twice the size it was when I joined it. And we have probably a cost structure that's 40% lower than when I joined. And we have an originations capability as well, too. So we've, we've built a business and a competitive cost structure. And, for 4 out of 4 years running, we're awarded, recognized for top servicing performance by Fannie Mae, Freddie Mac, and Ginnie Mae, again, without being the biggest in the industry. So I don't, in our industry, it's not necessarily about, raw scale drives competitiveness. It's creativity, it's innovation, it's focusing on the fundamentals that matter to your customers. And that's superior operating performance, superior value delivery, and a superior customer experience.
I love it, man. I mean, these interviews for me, I mean, yes, it's an opportunity to find potentially a good investment opportunity, but I think the wealth of knowledge from leadership on these interviews is worth a hell of a lot more. I mean, I love your style. I mean, GE is. I mean, come on, Jack Welch. You were with some big companies, Bell South.
Mhm,
I mean,
mhm,
these
mhm.
were some historic companies right here, right? And they've all gone through challenges. Every one of them. GE not long ago was looking like it might go bankrupt, right?
Yep. Yep.
I mean,
Yeah.
doesn't matter who you are if you don't change and adapt to the times. You can get hurt, and I think you are way ahead of the curve, right? And that I think you're not being appreciated for it entirely right now. But as the story gets out there and more people, I think two things will happen. I think you'll get more customers and you'll get
Yep.
some shareholders, right?
That's the goal, Tim. Is to, continue. Look, look. We want to continue to drive customer retention. We want to continue to drive customer satisfaction. We're super excited this year. Look, like I said, we've grown originations in the third quarter. I think our originations growth was 39% year over year versus an industry that grew 16%. And that's because we're delivering a value proposition that resonates with our customers. And I think of on the subservicing side, we signed up, 9 new subservicing clients so far this year, with 6 agreements under negotiation. We expect to add, 32 billion in new subservicing UPB in the second half of 2025. That customer base will deliver at $28 billion. We expect it will deliver $28 billion in subservicing UPB in the first half of 2026. Here's an example of, marrying technology to empower your people and deliver a better customer experience. So, we launched this year a product called Loan Span Information Retriever. It's called Lassie. It's got a trade name of Lassie. It's your information retriever. But our subservicing clients always have a bunch of questions about, the work we're doing for them. So, can you tell me, delinquency on my portfolio, what's your policy and procedure for this, so on and so forth. So, before that, all used to have to be handled by, a person, and one of our client service representatives, they have a list of things they've got to do for clients to from complex responses on complex issues to simple responses of, okay, let me go hunt down a policy for somebody. And our goal is to address every inquiry that comes in from a subservicing client within 24 hours. So the question is, how do you take the routine mundane work again out from the client service representative and put it in the hands of the client so they can get information immediately when they need it, and we can focus our people on addressing the more complex, answering the more complex questions within that 24-hour time frame that we strive for. So, the AI, information retriever was the answer, right? So, our customers love it. Our subservicing clients love it. They're like, look, there's stuff when I just need a policy or a procedure. I want to know, a particular situation on a loan. I can just ask, Lassie what the, the information I need, and Lassie goes gets it for me. It either prints me a report, develops a report to me, emails it to me. I can get a policy email to me, all that good stuff, and I could deal with, my client service representative on some of the more complex stuff. So, again, it's all about obsessing over your customer, right? And driving a different, trying to create a differentiated experience to them. And look, there's people out there, Rocket's done a great job with this years and years and years and years. Dan Gilbert founded the company years ago. He's built just an incredible complex, an incredible institution. And he had a very similar philosophy, is we're just going to focus on doing it right for the customer all the time, and we're going to innovate and leverage technology to get there. And he's built something that's just truly incredible. So look, are we out there on a bleeding edge like a Rocket Mortgage? No, we've not been at it for as long as Dan and Rocket's been at it. But look, we've got a simple philosophy, a simple formula. We do like to be early adopters of things, but again, mission driven, purposeful. It's got to have a business value proposition that makes sense to the customer, the mortgage loan investor, or our shareholder. Yeah, it's just
All right, Glenn, how many shares outstanding, fully diluted?
fully diluted. I think roughly 8.5 million shares. I probably that's my gut reaction. 8.5, maybe 8.9 million shares. We do have one capital partner of the company who has some warrants that were granted them years and years ago as we were turning around the company. So including the dilution from those warrants on a net settled basis, maybe around 8.7, 8.9 million shares.
Which is nothing.
No, what I tell you, Tim, that's one of the bigger challenges that we face as a company is, look, our float is small. So, there's a, universe of investors who, really want to be in companies that have, sizable floats so they can get in fast, get out fast, and that types of stuff. I don't know what their trading philosophy is, right? But, people such as yourselves, there's, a bunch of other people who are, really focus on small cap, micro cap companies who, this year with, again, is our first year of having a shareholders relations effort in the company. The story seems to resonate quite nicely with, the small cap investor who, is looking, or our peer group, and again, companies that are much larger scale, 3 to 4 times the size of us, but we offer a better entry point. Unfortunately, our shares are trading at, at about a 75% of book value. Um, but I do think, look, given what we've built, the platform we've built, and what we think the future capability of the platform is, and the performance we've been able to demonstrate, we think it is, um, a offers, comparable performance at, a better relative value than some of our peers. We're not perfect all the time. As I can go down the plethora of, investment, we're not giving investment advice and all that kind of good stuff, right? But, look, I think we've got a very simple, straightforward strategy of how we're going to drive growth and competitiveness in this business. And so far, we've proven the ability to deliver results with that strategy.
So typically, and correct me if I'm wrong, but in your industry, if it's a rising rate environment,
Hmm.
the things slow down, right?
Hmm.
And
Hmm.
if it's a decreasing interest rate environment, that's when everything picks up.
Hmm. Hmm.
You're good in either scenario, yes?
Yeah. So Tim, great point. The first element of our strategy was balance and diversification, right? So in the mortgage business, the origination side of the business where you're, originating new loans, likes a declining interest rate environment because more people refinance, more people buy homes when interest rates are declining. So originations, people are, I'm an originator and rates are coming down and I look amazing, right? So during the pandemic, there was all these origination centric business models that looked amazing. Even Rocket, for example, looked amazing, and Loan Depot and Home Point, and there's a bunch of folks who, IPO'd or SPAC'd and did all that kinds of stuff during the pandemic. They were originators operating in an ultra low interest rate environment, and that looked really great for them. But on the other hand, servicing centric businesses, so once the loan is originated, the folks who do the mundane activity of, sending out invoices, paying taxes, paying insurance, all that good stuff, right? Of what it takes to, service the loan over time. Servicing businesses like rising interest rate environments because your portfolio runoff slows when interest rates rise. Things like the, custodial balances, think escrow balances, earn more interest income. Your servicing expenses tend to be lower because you're not dealing with, having to do payoffs and things of that nature. So there's certain expenses that move out of the business. So our goal was to build a scale platform in both originations and servicing. So, I think our correspondent platform today, again, we're a top 10 correspondent originator. So correspondent is a form of originations. And we're also a top 10 loan servicer. So, as interest rates change, servicing and originations can balance each other. So, what we saw in the third quarter, for example, was record origination volume growth and servicing earnings appreciated. But, mortgage servicing runoff went higher. So servicing earnings were, on a relative basis depressed versus, where they may have been a year ago. But originations was up. And that creates what we call an all-weather business. So there's always timing differences in terms of when origination is recognized, origination income is recognized, when servicing runoff is realized through the P&L. So you may see quarter to quarter fluctuations, but over the long haul, we want that origination and servicing balance so that when rates are low, originations becomes the earnings driver of the business. When interest rates are high, servicing becomes the earnings driver of the business. Now, balance is super critical. And interesting enough, we talked about Rocket, right? So Rocket recognized they didn't have that balanced business model. and they acquired one of the largest servicers in the country, Mr. Cooper, and they recently closed that transaction. And now they've built that balanced business model. So, humble little Onity. we were we were all about that. And Rocket Mortgage recognized that as well. And look, I think those guys do a lot of things right. It's an amazing company, an amazing group of people. But even the big guns of the industry recognize that balance is super critical.
Right. Let me ask you a question, Glenn. What do you see as, I mean, a lot of people they have an exit in mind. Do you have an exit in mind?
Look, the management and the board of directors recognize, look, we work for shareholders. Our job is to maximize shareholder value as a company. So we've always maintained the flexibility, to evaluate any and all actionable and credible opportunity to maximize value for shareholders, and that could be small or large. An example of that would be, in the third quarter, I should say just recently, actually it was right after our third quarter earnings. Look, we announced a strategic transaction with Finance of America where, we're going to sell our reverse mortgage servicing rights to Finance of America. They were going to assume our originations business. We're going to get out of reverse mortgage originations, and be a key subservicing partner for Finance of America. And there's part of the transaction where there's new loan volume that comes our way, and we're going to resell some of their products into our portfolio. So look, the reverse mortgage business was a niche business for us. It was one that, quite frankly, a lot of shareholders struggled with just trying to understand. It's an esoteric business, it's a complex business. It's not, most people are familiar with forward mortgages, not reverse mortgages. And it was something that we used really as an interest rate hedge in our business because the value of reverse MSRs moved in opposite directions with interest rates as forward MSRs did. But look, we've gotten really good at our derivative-based hedging program. We've got a good portfolio recapture platform. So, did we really need to have this niche business that was complex for shareholders? And quite frankly, they didn't know how to value it, right? So, we found a transaction where we could monetize our reverse MSRs at book value. And free up capital about 100 million. We estimate about $100 million of capital to redeploy in our business to grow the forward side of the business. So there's we believe an accretive transaction for shareholders, which allows us to redeploy capital to do things like reduce leverage, invest in growth, and perhaps think about returning capital to shareholders. We've got to get the transaction through the approval process and all that kinds of good stuff, and reevaluate our capital allocation priorities. But there's an example of, look, the fifth element of our strategy is dynamic asset management. So we don't fall in love with any asset that we have on our balance sheet. And if it makes more sense and it's more accretive to shareholders to part with an asset and raise cash and do something with it, and historically we've found opportunities to, where assets were trading at disproportionate prices relative to what we thought the value was, and we've monetized assets, we've bought back shares. So, we are flexible in our approach to asset management. We're flexible in our approach to our business portfolio and the services we offer. But it's all about delivering maximum shareholder value. And I think this day and age, it's not just about growth. It's not just about productivity and technology, but what are the strategic things you could do that could perhaps, be a value maximizing transaction for your shareholders, both small and large, right? It doesn't have to be, something enterprise wide. It could be, sub portfolio like we did in reverse.
Right. I love it. I love this story. And I think we have done a pretty good job of telling that story. I mean, is there anything that you would like to for anybody that's watching? I mean, define your customer. Who is your customer?
Yeah. So our customer, we are a B to B to C business. So our primary customer is a business. It could be a bank, it could be an independent mortgage bank, it could be a credit union, somebody who's originating mortgages directly with a consumer. We buy those mortgages through our correspondent channel as what's called an aggregator. So we bring them all together, and then we sell the mortgage loan off to Fannie Mae, Freddie Mac, or Ginnie Mae, and then we retain the mortgage servicing rights. And from that very same customer base, we also buy mortgage servicing rights. So loans they've sold to the Fannie, Freddie, or Ginnie, and they don't want to hold the MSR, and we buy the MSR. We then have that consumer in our portfolio, and now we service that consumer. And when they want to refinance or potentially purchase a home, that's what our business to consumer channel, our consumer direct channel focuses on working with that customer to help them refinance or purchase a new home. So it's a business client first, the consumer second. Now, mind you, we are servicing loans for Fannie Mae, Freddie Mac, Ginnie Mae, in some case, private investors. So guess what? The mortgage loan investor is another very important customer segment for us. So delivering top tier servicing performance for your mortgage loan investors is really pretty critical. And again, the client compared, the business client is all about value proposition, speed, and ease of doing business. Being able to monetize their loans as fast as possible. The consumer, you just got to do it right the first time, all the time, and be there for them when they need you, whether it be for a loan modification, a workout, or a refinancing or a home purchase. And for the investor, it's, there's a massive rule set that go around servicing loans. And we have to not only comply with that rule set, but perform better at servicing those loans than our competition does. And we strive to do that as well.
Yeah. So this is the kind of company that if you're looking to buy a new home, right, you try to get your loan through ONIT,
Yeah.
right? And
Yeah.
and you buy the shares of the stock, right? Because, well, they do such an amazing job of servicing your loan. I mean, there's I'm one of those guys. I used to not be an early adopter. I'll just tell you that. I held on to my BlackBerry way too long.
Yep. Yep. Yeah. Yeah.
I like
That
that little
happens.
keyboard, man. I tell you, I really did like that thing. But uh, I have learned as I've gotten older that you really need to kind of pay attention to the world and what's happening around you and try to be in that
Yeah.
where the puck's going to be area. And maybe I'm a slow learner, but I have been, look, AI today, I use AI every single day. I talk to it like it's my best friend. Uh, I I can't remember the last time I used Google search. I don't use Google search anymore.
Yeah.
It's just amazing, right? And
Yeah.
I love it.
Yep.
I look at it and I think to myself, man, we should have a bunch of Einsteins, youngsters running around. Everybody, because anything you want to learn is right at your fingertips. I mean, it is just amazing to me. And unfortunately, we're not focused on it doesn't seem as though we're focused on the important things, right? And I think that if we could change that, if we could somehow make people understand that by using your time wisely, because you only have so much time, that's the one thing that you can never get back, right? Once you spend it, it's gone.
Hmm. Hmm.
And I think if people learn to spend their time more wisely, that we could do a really amazing things in this world. And um, these small companies provide a pathway for that for the retail investor, right? That's how you get ahead of the curve is finding the companies that are making a difference, that solve a problem, fill a need, right? I think that's one of the things that I try to focus on is does this make us better? Does it make the world better in some way, right? And if we all focused on that, if every day we all tried to focus on how do we make the world just a little bit better, I think we could do amazing things, right? This
Most
company
definitely.
right now is sitting at $44.25. It actually has a cup with handle formation. Now, I'm not a technical guy, Glenn, just so you know. I actually
Neither am I, by the way.
I used to look at charts or the chart guys and say, what the hell is a chart going to tell me about where it's going, right? I mean, I could never understand that because I'm a fundamental guy.
Yeah.
And then about 17 years ago, I took a technical course, and now it's the first thing I look at is the chart. Not because I am necessarily relying just on the chart, but what if you can match a good chart formation up to a good fundamental story, then I think the odds of success increase greatly, right? You have an excellent looking chart. You're bouncing up against this $44.25 mark. And I think if you could take that out and you take that out with some authority and you stay above it, I think that you are in a new upward trend. The stock is already in an upward trend. It's been in a channel, let's see, since what was that? May of 2020, April of 2025, and it's really kind of stayed within this channel between 36 and $40 for a while, right? And there's a lot of support there at $40, and you just almost pulled back and tested that after a little breakout. But I think this thing, if you can take out $45 or actually $46 and stay above it, that becomes your new floor, right? You have a small share count. We didn't talk. How are you on cash? Are you good on cash?
Yeah, we typically run the business to have total liquidity between 180 to 220 million dollars at the end of every quarter. Look, we have a capital light growth philosophy, Tim. So we typically want to grow our servicing portfolio 50% with subservicing, 50% with owned MSRs, and we have a number of different financial partners who like to invest in MSRs, and we subservice for them. So, I don't feel today, again, with a disciplined and prudent approach to organic growth. I think between our capital partners and the cash we have on hand, I feel like we have a trajectory to continue to grow our servicing portfolio. So I don't, look, I don't feel like, um, again, assuming we don't radically change our business model, we think our capital partners and our cash flow generation is adequate to support, the continued growth in our servicing portfolio.
You think at some point, and maybe you already have people knocking on the door. I would think somebody would want to gobble you up.
Yeah, and like I said, the management team and the board of directors is all about maximizing value for shareholders. So, we'd entertain any actionable and credible, proposal look, if it can maximize value for shareholders, that's great. Um, I think historically, the business was not that attractive, as we talked about. So I'm sure there's a lot of people knocking at our door, type of thing. But look, the business has gotten substantially more attractive. I think the assuming a reverse mortgage transaction gets approved, that's another simplifying step that makes the business easier to think about. And frankly, probably makes it more attractive because owning reverse MSRs is a very esoteric business. So and if anything, was probably holding us back from a growth perspective, just in terms of focus, right? You had to focus on too many things. And then, one of the legacy subservicing relationships, the customer that used to be 60% of our servicing portfolio, that's wound down to about 10% of the servicing portfolio. It's
Wow.
it's not a profitable relationship right now. After corporate allocations, before corporate allocations, it's one of our least profitable portfolios. We're going to transfer that servicing back to that client during 2026. So when I think about what the company looks like exiting 2026, it's a much simpler story, right? You don't have this big customer concentration. You don't have this hangover relationship. Reverse, assuming Ginnie Mae approves the transactions, the regulators approve it, will now be a subservicing business. It's a cleaned up balance sheet. Who knows, right? The business will, from a balance sheet perspective, look much simpler, much cleaner, than it ever has in the past. So, we'll see. We'll see what happens. But look, at the end of the day, we're going to here to run the company, deliver what what we said we're going to do. It's all about say-do ratio, Tim.
Right. Glenn, I appreciate you taking the time. You feel as though I missed anything?
Now, look, hopefully we'll have plenty more times to engage and we can cover other topics as we go. But look, we cover the high points for now, and look forward to continuing the dialogue with you and your followers.
When should we check back in with you? When do you think you
Yeah.
might have a catalyst?
Look, let's it's always a good time to talk after after any earnings, right? So after earnings, we recap the quarter. We'll talk about as we do every year when we do our year-end wrap up. We talk about what our priorities are for the next year. So look, let's talk at the first quarter next year, sometime after earnings, and we can get an update on the reverse transaction, an update how we're thinking about 2026, and yeah. I think we'll figure out a couple of new topics to chat about.
I love it. Wealth of knowledge right there.
Eh.
I really enjoyed this. I did. I enjoyed this
Me
conversation,
too.
and I look forward to our next. Do me a favor. Hold on one second. Now, this is what I suggest, people. What I would suggest is you go to their website, you sign up for their email alerts, and I think this is a fantastic story. I think good things are going to come in the future. I'm not guaranteeing anything because that's not what I do. My crystal ball is very cloudy. My crystal ball is never real accurate with timing, but I am pretty good at recognizing good opportunities. So I think this fits that category. And this is one to definitely keep an eye on, keep following. And we are going to do that here. And I look forward to doing this again soon with Glenn. All right, that's it. I'm going to shut this off, Glenn. Hold on one second.
Yes, sir.
Thank you for tuning in to another CEO interview here at Alpha Wolf Capital. Today we had Glenn Messina from Onity. I hope you enjoyed today's interview, and if you did, do us a favor, give us a like. How about give us a share? And while you're at it, make sure you smash that subscribe button. All of those things are extremely important to us here at Alpha Wolf Capital, and we appreciate you taking the time to do that. Until next time, stay safe. Alpha Wolf Capital wishes you the very best of success.